Institutional lenders for real estate finance, Unit 3. Commercial banks. Commercial banks originated from Goldsmith and other people dealing in precious metals that led to the evolution of checking account systems or demand deposit, and also underwriting, meaning who's a qualified borrower? Am I going to lend you money or a precious metal? Am I going to get paid back? Are you a qualified borrower? Do you have collateral to support the loan I just gave you? Some of the activities of commercial banks include interim financing, which would be construction loans, home improvement loans, manufactured home loans, equity loans, mortgage banking, and trust activities, meaning they'll be the trustor for a group to protect assets. Commercial bank products. Construction loans are called interim financing. Normally, they'll be 9 to 24 months. For example, a construction loan example would be if you bought a lot for $100,000 and your construction cost to build would be $400,000, you would go to a commercial bank and apply for a loan for $400,000. Normally, commercial banks will lend up to 80% of landing costs. So if your landing costs are $500,000, 80% of that is 400. So you still have $100,000 equity left in the property. Once again, it's short term, normally 9 to 24 months. After the construction is complete, you'll go out and get a permanent loan or a takeout loan to pay off the construction loan. They'll also offer other equity loans, home improvement loans, debt consolidation loans, but they're normally lending on the equity that you have in your property. However, you can normally get 80 to 100% of value on a commercial equity loan. Commercial banks also lend on manufactured homes. Normally, when you have a manufactured home, depending on the size, and it's affixed to the ground, you call it real property, and you can get any type of loan with that. 30-year fixed loan, 15-year fixed, FHA, VA guaranteed loans, or conventional loans. If it's a loan in a mobile home park, that's another animal because they're different entirely and really not, they are not real property. My advice would be to go out and find somebody that does handle these type of loans in a park that specializes in those and have them in your back pocket on your team if you plan to do manufactured homes in a park. Commercial loans also today will do mortgage banking. They can do loans and portfolio them and service their own, meaning they're keeping them inside and servicing those loans, or they can do other types of loans, Fannie Mae, Freddie Mac, government loans like FHA and VA, and close those loans and then sell into the secondary market to recoup their cash and then go out and lend other loans to other people. Savings and loans are thrifts or organizations that basically acquire their money through deposits and share certificates. They bring the money in and then let a portion of that money lend that out, maintaining a certain reserve requirement. They can do a couple of things. They can do portfolio products, meaning they're lending out their own type of financing, or they can lend mortgage banking type products where they can sell those into the secondary market. Under the California Chartered Savings and Loan Association requirements, they'll lend on 1 to 4 family residential units or multifamily, meaning 5 or more units and up. And normally, if it's 5 or more units and up, their max loan is going to be 30-year fixed. And if it's an interest-only loan or a non-amortizing loan, meaning as you pay, you're not paying any principal balance off, that's limited to 5 years. Life insurance companies have lots of money and very large holdings in California. They normally will like to participate in large projects like single-family development tract homes. They also can have participation financing, meaning they'll sell shares or stocks in a project where somebody can come in as an individual and buy a share in that and then receive benefits of interest as that project gets completed. and the money's used. They can also purchase blocks of single-family mortgages or securities from the secondary mortgage market. That's called mortgage-backed securities. So they'll buy that block and that block of loans and see the investment come in the form of interest that people are paying on those mortgages. Pension and retirement programs also have large pools of monies that they can lend out. In the past, pension funds might include PERS, which is the Public Employees Retirement System, or CalSTRS, which is a teacher system, and they can lend out financing to their members through CalSTRS. One area to look for also is the California Cal HFA through the state of California. They will lend higher loan to values, usually coupling a second trust deed with a first trust deed, which will help borrowers offset the down payment and also some of their closing costs. So they're coming in with sometimes no money down or getting 100% financing with some of those with some help with closing costs also. However, income limitations do apply. They're mainly looking for people that are low to moderate income. Credit unions are also big in the mortgage market now also. Credit unions generally will gather their money from their members. And usually what they'll do is really benefit their members. Their members can borrow at lower interest rates and lower fees than the competition. A lot of times portfolios too will come out when they're trying to gain members and come out with a portfolio product that only they have and they'll service that. Generally, it's a low start rate. Most often they'll come out with a 5-5 ARM, adjustable rate mortgage, meaning it's fixed for 5 years, and then every 5 years after that it changes based upon the cost of funds in the market. The advantage being that the start rate is much lower than traditional 30-year fix. So some people like to go with that. One of the disadvantages, however, if you're in your home for the long run, it'd probably be more beneficial to have a 30-year fixed rather than a 5-5 ARM, which changes every 5 years. Um, because if the market does change and you get stuck with a higher interest rate down the road, not very beneficial to you. They're also expanding more into the mortgage banking realm, where they can do Fannie Mae, Freddie Mac, sellable loans, and also FHA insured loans or VA guaranteed loans, and then they'll sell those into the secondary market. Commercial banks are a great avenue for someone looking for financing. One of the things you may want to do also is buddy up and make a part of your team a mortgage broker. Very often, many times, the commercial banks will offer a broker program where mortgage brokers can submit directly uh, to the commercial bank, credit union, or wherever, and get the loan for your clients.